Last year was a bad year for both stocks and bonds. The typical investment advice is put 60% of your money in equities that are more risky but with high return, and 40% in government bonds that are lower yield but more stable in terms of price.
Right.
60-40, 70-30, risk parity depending on your age and risk profile. But that assumes that the price of equities and the price of bonds are negatively correlated. Risk on, risk off, growth and recession. Most of the time that's the case. So there is growth and risk on, you make money on your equities, but the bond yields go higher, the price falls, you lose money on your bonds. Or risk off, recession, equities do poorly, but then bond yields fall and the price goes up and you make money on your bonds. What I argued in 2021, even before this shock, I wrote a piece saying inflation is going to be bad both for stocks and bonds. And that's what happened last year. Bond yields were higher, the price was lower, and the price of equity was lower. So the correlation between the two became positive rather than negative. So you lost money on equity and bonds. Why? When inflation is rising, the discount factor for your profit dividend is a long-term bond yield is higher, and therefore equities fall like it did last year because you have higher return on bonds. And long duration assets like growth stocks, tech, VC, all these things lose even more money because they are long duration assets where the dividends come later in the future. So they're even more sensitive to a rise in interest rates than traditional stocks. That's why Nasdaq fell 30%, S&P 15% only. But when bond yields are higher, the price of the bonds is lower. So last year you lost more money on 10-year treasuries that are supposed to be safe than you did on equities because S&P fell only 15% because the correlation became positive because of rising inflation. So people forgot that happens when inflation is rising because we had decades now of low and stable inflation. And last year there was nowhere to write because public equities did poorly, private equity did poorly, tech stocks, growth stocks, VC, venture did poorly, REITs and anything related to real estate did poorly, bonds did poorly, credit did poorly because credit spreads were widening, high yield, high grade, and the price was falling. All the bubbles like crypto, meme stocks, SPACs fell 80-90% because they were totally speculative bubbles. And even cash, if you hold cash, gives you zero nominal return. In real terms, with inflation at 10, you lost 10% of the real purchasing power on your cash. So you have to find alternatives. What are the alternatives when inflation is high? And the same thing can happen over and over again because suppose inflation goes from 2 to say 6% on average over the medium term, 10-year treasury then have to be 8%, 6 for inflation and 2 real. Today are only 3.5. So last year they lost 20%, but if they go from 3.5 to 8%, they will lose another 50%. So you want to be in inflation index bonds. They're protected against inflation automatically. You want to be in very short-term treasury bonds that reprice to a high yield without the price loss of long duration bonds. You want to be in gold, green metals, and some other commodities that do well when there is high inflation. Gold does also well against geopolitical and political risk and financial crisis risk. And then some forms of real estate, public REITs in areas that are sustainable, not damaged by climate change, might provide you some edge against inflation because they tend to do better than equities because you have some pricing power, rents can be adjusted. And as long as real rates don't go too high, real estate doesn't do as poorly as equities. So there are other asset classes you have to think about when you want to protect yourself against even gradually rising inflation.